Hello and welcome to What Keeps You Awake.tv. It's time again to dive into the hustles, the hurdles, and the highs that keep small business leaders up at night. I'm your host, David Hooser, and I'm especially excited to welcome today's guest, Zach Haptonstall. Zach is the CEO and co-founder of Rise48 Equity, a multifamily investment company that has completed over $2.4 billion. Did I get that right? 2.4 billion?
Yes, sir. Yeah.
Amazing. In total real estate transactions since 2019. You sleep much?
I've been getting better sleep the last year or so, David. Yeah, so it's been good.
Okay, well, that's good to hear. We'll get more into that in the episode. This is an amazing accomplishment as real estate investment is fairly new to him, having a background in healthcare and even TV journalism. Zach, welcome to the show.
Thanks so much, David. Really excited to be here. Thanks for having me in this awesome studio. So I'm looking forward to it.
We love it. So let's get started with our foundational questions.
Sure.
Tell me, as an entrepreneur and a new father, what keeps you up late at night? I know one thing.
Yeah, I know, right?
New father.
You know, I'm actually really lucky. Our firstborn son, he's like 14 months old now, and he has slept through the night since like the second week of his birth. So I've been fortunate there.
Wow.
And I would say the last few years, interest rates have kept me up on some nights. That's been the biggest universal challenge across the industry.
Right.
But overall, I try to get 8 hours of sleep, David. So I think that's important.
I mean, for health, for managing a growing portfolio like you have.
Yeah. And to be honest with you, I can tell you, like in 22, 23, that's when interest rates started to skyrocket, and I was feeling a lot of stress. Right. And I was just getting into bad habits where, I've always been pretty disciplined, where I don't drink alcohol, I don't smoke anything, I just drink water, coffee, and pretty much eat the same thing every meal. But I would work out. I would stay till the office till 9 p.m., then work out, and go to bed at 12 or 1.
Right.
And then wake up at 6 or 7. And I wasn't getting enough sleep. So when we had the baby, it actually forced me to be more disciplined. Where I started waking up at 4:30 a.m., work out in the morning, leave the office at 5 or 6, get 8 hours of sleep. So anyways, not to get on a tangent, but sleep is critical, as people know.
And reducing those things that impact a good night's sleep. The stress of business, the stress of family, the stress of political, social, activities.
100%. Yeah, I try not to watch any TV at night. I'll drink coffee early in the morning, 5 a.m.
Okay.
And sometimes I'll take a shot of espresso 12 or 1 p.m., but I try not to. So I try to have no extra half-life of caffeine in my body, so I sleep well.
Well, I can't say I'm very compatible with you in that regard.
Yeah, you're working on it, David. Yeah.
So I actually, in my education business, tried to get a partnership with Pepsi on this brand.
Really?
Not that we're here promoting it.
Yeah.
But I had a program I called the Education Rock Stars.
Really? Okay,
Yeah,
that's
so
cool.
We were trying to get some funding for certain demographics of kids.
Yeah.
And so I kept pushing for that because of my connection to them.
Right.
And of course, my business, which was in the education space.
Yeah,
so
makes sense.
it never worked out.
They're lost, David.
But you tried.
Yeah, that's
But
right.
you tried.
Yeah, at least you gave it a shot. Yeah.
So tell me a little bit because that's what gets me, and I truly mean amazing what you've done since 2019, and it wasn't your focus up to that point. How'd you get into real estate investing?
Yeah, great question, David. So real quick background. I grew up here in Phoenix, Arizona.
Okay.
Just grew up in a lower middle class family. My dad worked in construction. My mom was in HR.
Okay.
Didn't have any real estate background. No rich uncle or wealthy family. My parents, always taught me work hard. Like most people, go to school, get good grades, so you can go to college and get a good job. And so that's what I tried to do. I had good grades growing up. I wanted to be a football player. And so I played a little bit of Division II football, realized I wasn't going to go to the NFL.
All right.
And so I said, okay, next best thing is I want to be a sports reporter because I love sports. So I got a journalism degree. I was a live news anchor, sports reporter for a short amount of time. And then I quickly realized, David, that you can't hardly make any money doing that.
Yeah.
And while I was going to school, I was working nights and weekends full time, like 40 hours a week, and to pay for school and taking out student loans. So that's kind of how I had to get through school. And I just started to realize, like, I started looking forward, like how my adult life would be if I'm making this much money. I'm not going to really be happy. Right. I'm not going to ever be financially free. Right. I remember when it was like my freshman year of college, I was 18. I read, Dave Ramsey's book on financial freedom. Sure. Right. And so I was all about, trying to just earn as much money as I can, kill debt. So I graduated school, decided I don't want to go into journalism. I was 21. I was dead broke, had a bunch of student debt, a crappy car. I was like, I need to make money. And so I was delivering medical equipment nights and weekends while I was going to school, just like an odd job I got. Sure. And so I was like, I realized, hey, I can make good money in healthcare marketing because I met some people through the industry. So I started, of all things, I got into hospice marketing. Okay. So hospice care, for those of the listeners that don't know, it's basically like end of life care, mobile nursing caregiving for people with terminal illnesses. Yeah. In their home. My job was wake up in the morning, drive all around Phoenix, and just cold call, walk into like hospitals, doctors' offices, assisted livings, build relationships like physicians, social workers, nurses. They call when they have somebody who needs hospice. They call me. I meet with the family, educate, get them signed up. So long story short, hospice is a very competitive and lucrative private business industry. Right. So by the time I'm 23, David, I'm making like $150K a year. I more money than both my parents combined have ever made. I bought a house when I was 23. Wow. I started going to school, getting my MBA at night. So I started doing night school, get my MBA paid out of pocket cash. And I finished out when I was 24. So by the time I'm 24, I'm making like $200K a year, have an MBA, killed all my student debt. My only debt is my mortgage. And I did that for a couple more years till I was like 26, 27. And I was just miserable, to be honest. I was now a director of marketing.
Successful financially.
Yeah, exactly. Yeah, I had kind of achieved the initial goal. Like, okay, I have a car. It's nice. And I paid it off. I have a house. I have no other debt. I'm just a single guy. And I'm like in a hamster wheel. And I have golden handcuffs, right? And I was like, I never wanted to be a hospice guy. It was just like a short-term plan. Right. And all of a sudden, I'm 5 or 6 years into it. And so I'm like, man, I want to do something big. I want to create financial freedom. And so I had started listening to like different books, Rich Dad, Poor Dad, kind of the cliche story applies to me as well. Yeah. And I was like, you know what? I don't know what
I met Robert last year.
Did you? Okay.
Face to face. I mean, obviously we've known of him forever.
I met him a couple times. Yeah. So like a lot of people he's influenced, I kind of read that book at the end of 2017 and I just realized, you know what? I need to do something else. And I didn't know what I wanted to do, but I knew that I didn't have any time with my job to kind of figure it out. Right. And so I knew I wanted to do something through real estate. So in January of 2018, I quit my job. I had a little bit of sweat equity in that company that I sold. Okay. And so I had been relentlessly saving money, like Dave Ramsey style, for like 5 years. Okay. So I had about $300K of cash, after all that. And I was like, I'm just going to live off of this cash.
You still had your principal residence.
Yep, I did. I didn't. Yeah, I still had.
Still living in Phoenix, still doing all the things here.
Yeah, all in Phoenix. Yep, all this was in Phoenix. So I sold my house, single guy, 26, 27, about $300K of cash, and I was like, I'm going to make money through real estate somehow. And I did not know anybody. I'm not trying to exaggerate. And when I say I didn't have a mentor, I'm not trying to sound arrogant. I just didn't. I didn't know anybody. I was looking at flipping homes initially. You know what I mean? And I started researching it, and I was like, wait a second, that's kind of like transactional. It's what I was just doing. Right. It's like the same thing with being a marketer. You got to put up numbers. I was like, how do I create passive income? So I started reading books, listening to podcasts, going to events, and started learning about, passive investing. I first was interested in mobile home parks. So I was like, you know what? I'm going to use my cash and I'm going to try to buy a mobile home park on a seller carry loan. So I started cold calling. I signed up for some data program where I can get people's information. I started cold calling these mobile home park owners, called like 90 plus people. None of them wanted to sell. And I was thinking of doing the math. I'm like, even if I got one of these little parks, maybe I make $2 to $3 grand a month and I have no cash. So long story short, David, I learned about the whole concept of syndication, which means that you can raise money from other people and I can use my time and energy and they can leverage my time and energy and I can leverage their capital so that it's a win-win scenario. Okay. And that's what I decided to do. So I lived off the savings, did not buy the first. Ultimately, I decided on multifamily apartments, bought the first deal 14 months after I quit the job.
How big a unit?
36 units, $3.4 million purchase price here in Phoenix. Okay. About a $1.4 million equity raise. And that was a grind. I mean, quick little story on that is that I needed to raise 1.4. I had about 165K left because I had burned through a lot of it.
Right.
I put 160 into it. So I was all in. And I just bootstrapped it. I found a 1031 exchange for 600K. Found a couple guys that put in 150, filled up the rest. So it was like a 4-month escrow, closed on it. And while we were in escrow for that first property, which closed in February of 19, I knew I was going to be out of cash and that I needed liquidity to buy the next one.
Right.
So a couple months before it sold, or before we closed on that property, I listed my primary residence for sale because I was all in, right?
Definitely all in.
I was all in. It's like I need to, and I was dating my then girlfriend, my now wife, and I said, babe, I gotta unload this house because I need liquidity. So like shortly after that, I sell the house. I get like 120K of cash, and the next week we won 2 properties in Phoenix, and I wired $100,000 non-refundable earnest money for the next one. So it just kept going.
This was out of your equity
from the house. Yeah. Yep. So we just kind of found a way to keep going. So I mean, kind of fast forward, I made no money. But by the end of 2020, we owned like 6 deals, 65 million of real estate. Which on the outside,
how many doors would that have been at that time?
Oh man, that was probably like a few hundred doors.
Okay.
Yeah, like a few hundred, 300 to 400, something like that. And I was dead broke because I made no money in 2018, 19, or 2020.
Sure.
Right, because all your money goes into the deal, the cash flow goes to the investors.
Equity was in your deals.
It's in the deals. So I had like $12,000 of credit card debt. Near the end of 2019, I had to go back into hospice marketing. Because my non-compete had ended and I was broke. And so I needed to make money.
Yeah.
So I went back into hospice for 18 months. I was the president and co-owner of a hospice company. And I was doing that during the day and running the real estate company at night. Finally, at the end of 2020, we start selling our first deals. So we start getting liquidity, and we used all that money to build out infrastructure. Right. So I remember I quit hospice the second time in February of 21.
Wow.
We hired the first employee in March of 21, and we just started building out infrastructure. We created a property management company. We created our construction company in 21. We got an office. And so, made no money the first few years, bought like 65 million. And then in 2021, we bought 16 deals, 560 million. And then in 2022, we bought another 16 deals, 860 million. So it's like I made no money. It was really tough. Finally break through. I mean, COVID slowed us down, right? When we started catching momentum. Right. Then we get through COVID. Now we're doing well. Then interest rates skyrocket in 2022, right? 22. So since then, we're recording this in July of 2025. We've been playing offense and defense the last few years because of interest rates. But we saw interest rates increasing as an opportunity to continue to scale and grow because a lot of groups were on the sidelines at that time. And so we bought our first 40 deals in Phoenix. And then end of 22, we said, hey, we should try to expand to a second market because all the big institutions are on the sidelines. And so we said, let's go to Dallas. And so we expanded to Dallas and bought the first deal beginning of 23. We were the number 1 buyer in Dallas in 2023. We bought 8 deals there and really able to get a foothold there in the Dallas market. Then we expanded to North Carolina in 2024 last year. And so, since 2019, about the first deal, we've now acquired 58 assets, over 11,000 units. We've sold 11 of them. So we currently own and manage just over 10,000 units, a little over $2 billion of real estate. We have a property management company, a construction company, an HVAC company, and we've got a little bit over 320 full-time W-2 employees. So we've been able to just keep grinding through, the different adversity that we've faced.
And what is when you're looking at a deal, what's your what is your typical goal? Is it free cash flow on the property? Is it appreciation and value? What are your
good question.
Formulas for success on that?
Yeah, it's really a hybrid of what you just mentioned, David. So basically, we want to have free cash flow in year 1, but we also want to have some type of value add upside for the deal, right? So we're typically trying to find deals that we can go in there and execute a value add plan. We're renovating interiors, exteriors, putting professional management in place to enhance and optimize the net operating income and the value of the asset. So we're trying to typically double investor money over 5 years.
Over 5 years.
Yep. So we're looking at we look at the location as far as median income, crime scores, jobs nearby. We are, strategically in markets like Phoenix, Dallas, and North Carolina that are top 10 in the country for population growth, job growth. They're landlord friendly. So if people don't pay their rent, we can evict them.
Markets that are.
We can get them out. Yeah. So we just kind of rinse and repeat that same model over and over.
And what, let's take an example of Phoenix. What are some of the areas of the Phoenix market that you have a presence in?
Yeah. So, we are throughout the Phoenix metropolitan area right now. So we're in, Phoenix proper, Glendale, Mesa, Tempe. Okay. We've had assets in Scottsdale. So pretty much all the major Phoenix MSA. We just got a new deal last week. It's going to be in Mesa. That'll be our first Phoenix deal in over 2 years. It's hard to find deals. Yeah. So right now we have 29 assets, about 6,000 units in Phoenix. So it's all within like the heart of the main Phoenix MSA. No tertiary markets.
And you haven't built any of the assets that
we have not. No, but we want to get into that. So we actually have just been meeting with builders the last couple of months. Okay. And so we want to develop multifamily and kind of open up that line of business as well here in the future. Okay.
Any other types of properties you're looking at right now? Storage or?
No, not right now. But I think that, our goal ultimately, this sounds kind of cheesy, but our goal is to be like bigger than Blackstone. We want to be a massive real estate institution. And
multifamily.
So for multifamily, retail, storage, senior living. Okay. So we want to have all of these different lines of business and have leadership teams for each one of those. And so, in the future, we look to get into all of those.
So on you mentioned you've already turned over, what, you said 11?
11 deals, yeah.
Why, if your goal is that doubling in 5 years, because you're just 6 years in the making, right? 7 years.
Yeah, good question. So we sold the first 11 deals we bought. That was when interest rates were low. And we were buying these deals mostly off market. We were going in there and renovating the units, executing the value add plan, increasing the value. And then when we could pull the trigger and sell the deal to double the money, we were. So we averaged to more than double the money across those deals for the LPs, the investors. Okay. And so once we could hit that return, and that was in like an average of 18 months. And we never projected that. Right. I've been telling investors the last few years, hey, we're not going to double your money in 18, 24 months. We never said we would in the first place. With interest rates, it's not going to happen. But once we can hit that value, we've sold it, pull the trigger, sell it, lock in that profit for the investor, and then we do a 1031 exchange. Okay. And so we've completed 7 1031 exchanges now, so investors can kind of, out of the 11.
So do investors pull out, or do they? I would want to keep my money
rolling,
working.
Right? Yeah. So good question. They have the option to participate and roll the money into the next one and defer the capital gains tax, or they can cash out and they'll have a capital gains tax on the profit. Now, of the 11 deals we've sold, we've done 7 1031 exchanges. The other 4 we didn't do. We honestly just weren't thinking of it yet. But the deals that we've tried were 7 for 7, and we've had between a 90 to 95% conversion rate. Yeah, where they want to participate in the exchange. So
what do you think's going to happen? And I know your crystal ball is as fuzzy as mine, but because the Fed, everyone talking about dropping rates, that doesn't mean because the Fed drops the rates that equates to a lower mortgage rate.
Right. Yeah, it's more tied to the 10-year Treasury. Yeah. Right. Yeah, there you would like to think there's some type of correlation, but it's not a direct correlation to your point. And it's like, I can tell you, David, in 22, 23, I was an optimist. I was like, hey, the rates are going to come down. Right. But then after, nobody knows what's going to happen. I am like innately pessimistic now. Because even in September of 2024, the Fed cut the federal funds rate for the first time in several years. Right. And then there were all these projections that there was going to be several rate cuts coming in 25. Right. And then, the Trump administration comes in, and really in January this year, everything just gets turned completely around, right? Because of the Fed concerned about the potential effects of inflationary pressures from tariffs. Right. And so, they just shoot up and down. I was just met with my banker a couple days ago. He just texted me this morning. At JP Morgan, as of today, because this can change daily, they're projecting 100 basis point cuts by next spring. That's the Fed funds rate though, right? So for the 10-year Treasury, I couldn't tell you because it's so hard with everything that's going on globally.
Bond markets in flux, the dollars in decline. I mean, there are a lot of impacts right now. And so, it's questionable. And I almost think tariffs is an excuse for the Fed, not a real reason.
I do too, because we haven't seen, I mean, I know there's supposed to be a residual effect, but we haven't really seen it yet, right? It's like, so.
Yeah, but I mean, who knows what's going to come? And of course, we've seen, the current administration use tactics to impact what they want. But anyway, well, let's stay focused on your business. So, if someone is looking to invest in one of your projects, what's the process? So you do Reg D.
We do Reg D. We've done what's called 506B and 506C. We prefer 506B, and the reason for that is it's just easier. We don't need to market our deals. We never market our deals publicly.
Right.
And so basically what we've done historically is put out a bunch of content on like LinkedIn, SEO, Google Ads, which is basically just showing what we do for past projects we've already purchased, and just basically trying to generate inbound leads where people are seeing something and they're setting up a call with one of our team.
Right, because you can't really promote new deals.
No, we cannot solicit the new deals under a 506B.
But you can tell everyone, here's our history.
Exactly. You can kind of say, here's what we do. Like I'll do videos at properties saying, hey, we bought this deal at X date. We've renovated X amount of units, and here's the before and after. If you want to learn about how you can participate in these types of investments, set up a call with our team. So they'll set up a call with our team. And the first 2 to 3 years, David, I was cranking all these calls myself. Like there would be some days where I'd have no BS, like 8 to 10 calls a day, just back to back to back, 30 to 60 minutes each.
Right.
And so I've had hundreds of these calls with investors. And because some people say, how do you guys raise money? And I'm like, honestly, there's no magic bullet. We just freaking grind for every 50K, just pound the pavement. And then a couple of years ago, we started hiring staff to take these inbound leads. I helped create a script. And then obviously you start getting referrals, and then you get registered investment advisors and fund managers who bring you bigger checks. And so, but that's kind of how we've done that.
All right. Sounds real good. And so you're going to stay focused on the multifamily. You said you're going to start looking at diversification, still in the real estate space, more, products or verticals that, you see future growth in. Like I was telling you, my buddy just bought a commercial building.
Yeah.
You gotta have faith, to be putting that much money into that specific sector of the real estate market.
Yeah, no, I mean, I think we at this point are not really interested in the commercial space. I mean, I've talked to guys, and I think it needs to be, if you're going to buy an office building, it needs to be like A+ trophy asset, right? And those are the only ones that are doing well.
Location is everything.
Yeah, it's challenging, but yeah, I mean, I think in the short term, meaning the next 12, 24 months, we're just laser focused on multifamily. But in the future, we do want to expand when it makes sense in the market cycle to other asset classes.
So the vertical operations that you're building, the construction side, the HVAC side, that's mostly to support the deals that you either have in renovation or the deals that you're not offering those services to the Joe market, because you said you were doing some property management now for third parties.
Yeah, good question. So we initially created the property management, the construction, the HVAC for our own assets that we own. But last summer of 24, we actually had our lenders on our properties reaching out to us saying, hey, you guys are doing a great job. We just foreclosed on properties from other borrowers, and we need help managing this thing. And so can you help us? And so we actually started a third-party management company out of necessity to help manage these deals for our lenders. And that's just another business line. And so we're now managing over 1,000 units third party for our lenders. And they've asked us to execute those construction plans as well. So we are doing the construction, the HVAC on those assets as well. And, just this week, I've been interviewing, business development guys to bring on to help grow the third party arm, because that can basically, gain control of assets and then feed ancillary businesses. And so, this is kind of, the beginning of what we're starting into like a venture capital type of structure where we have the mothership firm, and then we'll have leadership teams on each ancillary business. Like we're starting a plumbing company right now. So you get like an operations expert, business development, and obviously all this, the labor to kind of, and each one of these companies will have a different brand, and it will support itself.
Oh, they will.
And it will provide third-party services. So it's not just for in-house. Oh yeah, we will. And we're actively hiring people to help market and grow these companies on their own 2 feet, so to speak.
So you're building an amazing organization, enterprise, and wow, such a short time. So my hat's off to you.
Thanks, David. And real quick, I mean, the reason we've done that, David, is because of the last few years with interest rates. We realized, you know what, if you want to be a big company that is successful and sustaining for decades, we can't rely on transactional compensation. We have to have recurring revenue, right? And diversification across multiple business lines to, be able to withstand these economic downturns.
Well, and it helps you on the cost basis as well. On a deal that you price out, if you with the interest rates now, that's such a big portion of the overall deal structure. You got to save somewhere, and so if you know that you're going to need these kind of improvements, and if you go to the open market, you're going to pay X, but if you have a vertical component in that space, then you save there. And
the perfect example of that, David, is HVACs. Okay. So what we do on each deal is we get 3 third-party bids on HVACs, and then every single time we can undercut it easily. And we realized for years we've been getting screwed by these HVAC companies. The profit margins on that business are ridiculous because we buy them in bulk, wholesale, right? So it's actually serving the investors and the property because it's cheaper.
Right.
It's better execution because our guys get out there quickly and get it done. And then there's a profit margin on that HVAC business side.
Right.
So to your point, it's just better execution all around.
All right. Sounds good. So someone looking at real estate as a business, any nuggets of gold for them? I mean, you did things that most people wouldn't do. You risked it all. Like you said, you went all in on yours. Are there other ways to other spaces that the aspiring entrepreneur might consider?
Yeah, I think that you just need to do your research, and you need to figure out, what aspect of real estate, because real estate is so broad, right?
It is.
And I didn't realize until I started getting into it. I was like, this is overwhelming. And it's easy to get the shiny object syndrome, because I was like, I'm going to flip houses. No, I'm going to do mobile home parks. So mobile home parks are competitive and saturated. I'm going to do self-storage. And I finally settled on multifamily. So I think that you need to really, whether you want to be big or small, I think it's important to just laser focus on a specialized niche of real estate. And then you just need to figure out, and maybe you're going to buy single family homes and rent them out, which is totally fine. But maybe figure out, what is your talent? Like, what are you really elite at? And what do you like to do? And what is your weakness? And if you can find at least one business partner or someone to help you where their strengths are your weaknesses, and you have those complementary skill sets, that's the biggest thing, David, I found, because you can't do it all yourself. I mean, for some things, maybe you can.
You might do have limited.
You'll be limited, which is fine. But if you want to scale a business, it just takes people, right? And it first starts with a partner or maybe a key employee. And so it's
an investor. Someone who believes in you, and we see that.
Yep.
What are your thoughts on the single family rental community?
Like the build to rent?
Yeah.
I think the build to rent is a great product, honestly, because I think from the tenant's perspective, the resident, they can't afford to buy a house because they don't have the cash for the down payment, or they don't meet the debt to income ratio requirements. So it's the closest thing you're going to get where it's low density, maybe get a garage. So I like the idea of it. We've stayed away from it because we are concerned about the affordability of it and the demographics that can serve that type of community, because, these rents are pretty high. They're premium. They're $2 to $3 grand easily.
Right.
And so, I mean, we've seen especially in Phoenix. I mean, Phoenix is kind of like the mecca of build to rent in the entire country.
Is it?
Oh yeah, it's number one. The last 4 to 5 years, there was all these companies buying up land, especially in the West Valley, and building these things, and it's just oversaturated with supply, and so they've been having to give significant concessions. But I mean, all the big money, the institutions have continued to invest in it. They're smarter than I am, and so obviously they see the potential there. And so I think that across the country, when you look at demographics, more and more people are going to be transitioning into renting, not only because they have economic constraints, but because maybe that's the lifestyle that they want. People don't want to own a house, these younger generations. So I think that it'll go more and more toward that. So I think that there's a long runway and future for that.
Yeah, and then what's another? What's the tiny home? What's that all about? Is that real?
I don't think that's gonna last. I feel like it's a fad. Yeah. I mean, I've seen some stuff online, but I don't know how that's really sustainable. You know what I mean? Because it's like, if you want to have a family or even a significant other, it gets tight.
But kids these days, I mean, for example, before we started the podcast, we were talking about China, and kids in China don't want to have kids. They don't want to have families. I tend to see that here. Kids here don't. It's kids wanting to get their driver's license is down. It was at like 40%. Now it's at 25%.
It's crazy, right? There's just a lack of less and less independence. It seems.
I can kind of get that, because there's so many issues and auto ownership, insurance, and
it's expensive.
And the risk, and parents, probably a little bit of the parents saying, "Hey, I can't afford your insurance."
And I think transportation has completely changed, right? With Uber, and in Phoenix we have Waymo, driverless cars,
and DoorDash, because everything come to me now. I don't have to go there.
Yeah, that's a good point. You don't have to go out and get stuff.
But with the question is, what are they going to do with home ownership? Are they gonna stay in their parents' basement for an extended period of time? Are the tiny homes something that maybe makes sense?
Potentially, because they're affordable. Yeah, it's just like, I don't know if there's enough of the communities of those things, right? I don't even know where they are.
Yeah,
I don't. So I don't. And I would think, I always say just follow the big money, right? Follow the Blackstones and the KKRs of the world.
Yeah,
and whatever they're investing in, they have the ultimate research and development departments, right? And so they know what they're doing.
They see the trends.
Yeah. And so if they're not doing it, but I do think that the whole modular prefabrication stuff, that's becoming more and more common. Sense. And I see big companies investing in that.
It makes sense. I've seen a few of the printed format homes that
I met a guy recently who owns a company that does that. It was pretty interesting. Yeah, he's like printing a house. It's kind of crazy.
It's such a mind-boggling.
I know. I was like, "What do you mean?"
Thought,
like you have to look it up. If you hear that, you have to like look it up to even understand what that means.
I think Lennar has a community in Dallas of all. We were talking about that they have really put a lot of investment in, but it's early stage, so who knows what it's going to look like. So things are going to be interesting over there. So this will be a good question to you, because maybe you're using AI in certain ways to improve the efficiency of your operation, but do you see an issue in AI because of unemployment, growth, because displacement to AI solutions, therefore that ripples into all aspects of our economy, and including
the renter base and tenant. Yeah, it's a good question. I honestly hadn't thought of that, David. I can tell you, I just tell people straight up, selfishly as a business owner, if I can cut overhead or replace bodies with AI, I'm going to do it because I'm trying to be efficient, and I have to make sure the business is running as well as it can. Right. But there are certain roles where you need the humans. I hadn't really thought of the whole tenant base, honestly, because that's why we specifically look for markets where there's job growth, because you need your tenants to have good jobs so that they make money and they pay the rent, and that goes to the investors and fuels everything, right? And so that'll be interesting to see how that kind of develops over the years.
How it impacts the lifestyle of our
and that could that could impact any consumer-based business,
Sure.
which is most of
Sure.
our economy, right? It's a consumer-based economy.
That's right.
Yeah. So,
So I'm reading more and more, obviously being in the podcast space now.
Yeah, I'm sure. Yeah.
Listen to a lot of podcasts, and
Yeah.
I've heard the term single employee $1 billion company.
Interesting. I haven't heard that.
In the future. So because
everything's automated, AI.
Automate everything.
Yeah.
So
it's
going to
interesting.
be an interesting world in the next 5 years.
Yeah, so it will be for sure.
It'll go fast. So, well, I want to thank you for joining us. And while we're here, any shameless plugs you might want to make. So if you're looking for, investors or how you promote your company to, to the world, why don't you take it home?
No, I mean, if you ever are interested in investing with us, you can go to our website, rise48equity.com, RISE48equity.com. Or if you want to work with us or partner with us, we're always trying to find good people. That's what I've found is like, if we can get key people, email me, Zach, ZACH at rise48equity.com, and I'll connect you with our team. But I appreciate that, David. And thanks for having me. Really appreciate this.
Everyone out there, remember to like or subscribe to whatkeepsyouawake.tv. Thanks for joining us, and tell your friends to catch an episode in the near future. Talk soon.